Hi class, today we will be taking a look at depreciation, how some of our long-term or medium-term assets lose their value over time. Today's lesson, Introduction to Depreciation, we are in Module 2, completing the accounting cycle, covering the outcome, prepare adjusting entries for prepaid and depreciation expenses. Let's take a look at assets. We've already covered assets, but it's good to get a quick refresher before going into a more complicated concept such as depreciation. So, assets, an economic resource that provides value for a business. Examples of assets are cash, prepaid insurance, land, machines, equipment, supplies, and vehicles. If we buy something for a company, we bring it into the company, those assets still hold value. They're a positive to the business. They give our business value. It's important that over time we keep track of what our assets are worth. A method of assessing the worth is depreciation. Some assets, such as cash, maintain their value over time. Say if I have a $100 bill and I put it in a safe for a year, I take it out, it's still going to be worth $100. There may be other economic factors, such as inflation, that might devalue my currency, but overall, my $100 now is going to be $100 tomorrow. But other assets lose their value over time. Think about when you buy a brand new car. On average, the value of that car decreases by 20% over the first year of use. How do we account for these changes as accountants? The method that we're going to take a look at today is depreciation. Well, the method that we use is called depreciation. The definition of depreciation, a reduction in the value of an asset with the passage of time due in particular to wear and tear. For our examples, we're going to be looking at work trucks, company cars, vehicles, simple terms, simple assets that we can wrap our heads around, that the more we use it over time, the less value it has in the future. Our method of accounting for depreciation is straight line depreciation. So let's get into it. So our key terminology we're going to be working with is, first and foremost, the purchase price. The amount we purchase for the asset is what we will be working with. So if I buy a truck for, say, $60,000, it's going to be accounted for as $60,000 in our books. For example, let's say the car we got, in the market, it's going to raise its value. Say it's a special edition. The market value, I could sell it right now for about $100,000. Very unlikely that happens, but we don't adjust for that changing in value in the books. If we paid a certain price for it, that's how we are going to account for it. The salvage value, the estimated amount we will sell the asset for after the useful life of the asset. So, if I buy a car right now for $40,000, and let's say I want to drive it for about 6 years, I can kind of ballpark estimate saying, if I drive for 6 years, I can maybe get about $15,000, maybe $10,000 if I'm lucky. We're going to be taking that amount and accounting for it in our examples. The useful life of the asset is how long the company plans to use the asset for before they sell it. In companies, they tend to want to have the best so they can generate the most value for their company and for their customers. The useful life, say it's about 5 years, we want to use it for 5 years, and then we're going to sell it for hopefully the estimated salvage value. The depreciable value, how much value the asset decreases over its useful life. Calculated using the formula purchase price minus salvage value equal depreciable value. So pretty much it's the difference between the purchase price and the salvage value. It's the amount on which the asset takes depreciation. Let's get into our first example. So here we have an asset with the cost of $60,000. So company car, $60,000. We're going to estimate that we're going to get about $15,000 of salvage value after its useful life for the company, which is 5 years. It says here in the example, the company has used the car for 2 years already. So we have 4 steps in front of us. First, we're going to calculate the depreciable value of the car. Step 2, determine how much depreciation accrued each year. Is accrued each year. Step 3, multiply yearly depreciation by the number of years the car has been used. Step 4, cost of the asset minus depreciation is going to be the value of our asset with depreciation. Let's get into it. Our cost of the asset is $60,000. We are going to minus our salvage value of $15,000, equaling $45,000. So we paid $60,000. We estimate we're going to get about $15,000 out of the car when we sell it, meaning we have $45,000 of cost to account for it with our depreciating formulas. Our depreciable value, so we're going to sell this car after about 5 years of service. So 45,000 divided by 5 equals a $9,000 depreciation cost per year. Now, we want to see how much depreciation is going to accrue over 2 years. So, we have $9,000 of depreciation occurring per year. Let's multiply that by 2 years of use, equaling $18,000 of depreciation. Finally, we take the cost of the asset, $60,000, what we paid for it, minus the $18,000 of depreciation, and we have a value. The value of our asset with depreciation is now $42,000. Now, using journal entries, we can adjust the value of our asset with journal entries to express how our company car lost value over time. Now, let's get into a word problem. Rush Moving Service specializes in transporting paintings and art around the city of Toronto. With their business growing, the owner of Rush Moving Service purchased a brand new company truck for the movers to use. The truck was purchased for $45,000, and the company plans on selling the truck after 8 years for an estimated $5,000. How much will the asset be worth in 3 years, accounting for depreciation? So, let's just run that down. So, our cost of the work truck is $45,000, with an estimated salvage value of $5,000. The company estimates its useful life is 8 years. The company has used the car for 3 years. So, how much depreciation has accrued on that asset over 3 years? Cost of the asset, $45,000. Take away the estimated salvage value, equaling a depreciable value of $40,000. Our depreciable value of $45,000. To figure out the depreciable value per year, we're going to divide it by the useful life of the asset of 8 years. 40,000 divided by 8 is a depreciable value of $5,000 per year. Now, we have been using the vehicle for 3 years at this point, with a depreciable value per year of $5,000. So, $5,000 times 3 equals $15,000 of depreciation have accrued over the 3 years. So, our cost of our asset, $45,000 minus $15,000 of depreciation, is going to come to a total of $30,000. So the value of our asset after 3 years of accruing depreciation is going to be $30,000. Within our next lessons of journal entries to account for depreciation, we will you will be given the skills on how to take accounting for depreciation and apply it to the books. Thanks for watching. Hope you learned a lot about depreciation and you can take these skills and apply it to your assignments. Thank you.